So the Federal Reserve is about to potentially stop, and people are really excited about making a lot of money in the stock market, which is kind of crazy because 2023 has been an insane year for all investors. We've had mortgage rates go up, commercial real estate is about to go into its own recession, some small banks have collapsed, we've had the debt ceiling crisis, which was just recently resolved, we've had a drop in company earnings, we've had the US take a stance against crypto, and despite the odds, the overall stock market has continued to go up. And now, something arguably even more important is about to happen this week because the Federal Reserve is set to stop. Don't worry, they're not ending the Fed. Instead, the stock market is predicting that this week, the Federal Reserve is about to stop raising interest rates for the first time in the last 15 months. And because of that, the stock market is expected to go up and potentially go on another bull run. Now, personally, I don't consider myself an expert. I don't try to time the market because I'm a boring dividend/index fund investor, and I don't make my own predictions because I don't know what's gonna happen, but I do try to make sense of them. And I'm excited for what's about to happen, and I wanna show you some new data and explain it like I'm 5 style, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic of data and the magic of stonks. So here's a crazy statistic that absolutely blew my mind. Right now, there are only 3 out of 11 sectors in the stock market that are responsible for the majority of the stock market's growth this year. Information technology, communication services, and consumer discretionary. It gets crazier. We know, for example, this one ETF, VOO, this one stock, which represents the top 500 companies in the US, which also happens to be the stock that Warren Buffett told his family to invest in after he passes away. This one stock is up 12.5% this year, which is mind-blowingly good. Because remember, at the end of last year, analysts were telling us that they thought the stock market would be doing really bad in the first half of this year.
But they were all of them deceived.
For there were 3 reasons why all of them were wrong. Why am I quoting Lord of the Rings? I think it's because the new Gollum game is really bad and I can't get over it still. Anyway, sorry about that. Continue.
There've been 3 tech rallies this year, right? You had the January effect rally in January, where the majority of leadership came from the worst performers in 2022. Then you had the rotation out of financials into tech. Then you had the AI boom, right? So I think a lot of investors on the first 2 missed it because they didn't believe it.
The market was just extremely pessimistic and analysts were completely blindsided and no one saw it coming. AI and its effect on productivity.
I think what's clear is that this AI revolution has blindsided the market, blindsided investors, blindsided some companies that were in the space that got blindsided by who was going to take the alleged lead in the arms race that we're witnessing, and now we're trying to play catch up.
And this is exactly why it kind of blew my mind. So coming back to this VOO ETF, this one stock, inside of it, it has the top 10 holdings that make up a huge chunk of this ETF. Mostly the big tech companies like Amazon, Meta, Microsoft, Amazon, stocks like that. Now, the top 7 biggest ones from this list are responsible for 77% of the stock market's growth this year. Put another way, 7 of these stocks are holding up the other 493 in the entire stock market. If you were a value investor who was trying to find individual stocks, like maybe a dividend investor, you would find that the average stock is down 1.2% this year. Now, that is both a good thing and a bad thing. It's a bad thing because if the whole tech and AI revolution and hype trains stop, that means really bad news for the stock market. But it's a good thing because compared to the tech sector, the rest of the market is severely undervalued, which gives it an opportunity to catch up and contribute to the overall growth of the market in the next 12 months. According to data from capital markets, for example, when 5 stocks outperform the S&P 500 as much as they have this year, the stock market has gone up by 11%. And that's why analysts are now reversing their prediction. Also because that's what they get paid to do, and now they're telling everyone that the stock market could go on another bull run. Now, whether or not that will or won't happen, I don't know. I'm not an expert. I have no idea because I don't make my own predictions, just trying to make sense of them. But whether good or bad things will happen, will depend on what the Federal Reserve will do tomorrow. When it comes to investing, I think our loved ones deserve a financial safety net, and we deserve a smarter way to find it. And that's why I want to share with you the sponsor of today's video, Policy Genius. Policy Genius was built to modernize the life insurance industry. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. With Policy Genius, you can find life insurance policies that start at just $25 per month for $1 million of coverage. Some options offer coverage in as little as a week and avoid unnecessary medical exams. Their licensed agents work for you, not for the insurance companies. That means they don't have an incentive to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents and caretakers and anyone who has people that depend on them. They simplify the process of getting life insurance so you can protect the people you love. There are no added fees and your personal details are private. No wonder they have thousands of 5-star reviews on Google and Trustpilot. Head to policygenius.com/Andrei Jikh or just click the link below to get your free life insurance quotes and see how much you can save. Thank you, Policy Genius, for sponsoring this segment of the video, and now let's get back to it. So the Federal Reserve is set to have another FOMC meeting this Tuesday/Wednesday to figure out what they want to do with interest rates, specifically the federal funds rate, which is the cost for banks to borrow money from each other. When they raise the rate, it's more expensive to borrow money, and therefore, hopefully, it means it lowers our spending, and that's how they fight inflation. That's why interest rates have gone from 0% 15 months ago to now 5%. And it looks like it's working because inflation is coming down in what's called the CPI, the Consumer Price Index, which is how they measure inflation, and we can see it in the data here. And on Tuesday this week, we're gonna get the latest inflation data, which will probably be lower than our last reading of 4.9%. That's when Twitter will start to fight again. And that's because they're usually confused about what inflation's actually measuring, and all it's doing is it's measuring the rate of price growth. And right now, prices are still growing, and they're growing fast, but they're slowing down. That's all it's measuring. Now, the question is, if prices are still growing 4%, still not where it needs to be, 2 to 3%, why is the Fed wanting to pause the rates? It wants to pause the rates because there's a problem with inflation. The data is always behind the truth. Rent data, for example, is usually 12 months behind, and the true inflation rate could actually be closer to 2.7% according to Truflation, which is exactly where the Fed wants to be, between 2 to 3%. That's their sweet spot without affecting unemployment. And that's the real reason why the Fed wants to think about pausing or maybe skipping the next rate increase. Now, there is another reason why interest rates are the talk of town this week besides inflation, and that reason is because people are really looking forward to making a lot of money in the stock market. And history shows that out of the last 11 rate hike cycles that we've had, the S&P 500 has grown by an average of 14.8%. And analysts are specifically referring to the 12 months that follow the end of said rate hike cycle. So what this means is that when money is expensive to borrow, when rates are really high, this has a shrinking effect on the economy because people borrow less, so they spend less. Now, when the Federal Reserve pauses those rate increases like they're potentially about to, this leads eventually to rate decreases, which has the opposite effect. People start to borrow more, so they spend more money, which increases the growth of the economy. And since the stock market is always trying to predict what will happen to the future, it's predicting something really good about our future based on data from our past. Since 1990, for example, data shows that the Fed has paused for an average of 10 months before the first rate cut cycle. So the market is assuming that once we pause, which will potentially happen this Tuesday/Wednesday, that 10 months from this week, the Fed could start to lower interest rates. And I say potentially because no one knows for sure, but like Aladdin, I can show you the odds. And here's what I'm basing my information on. The CME Fed Watch tool. Right now, it shows us that the target rate, which is just fancy for the current rate, is 5 to 5.25%. And it also shows us there's about a 70% chance that this week the rate will stay exactly the same, 5 to 5.25%. And on the opposite end, it shows us a 30% chance that the new rate will fall between 5.25 and 5.5%. So what that tells us is that there's a 1 in 3 chance right now that this week the Federal Reserve will raise their interest rates by 0.25%. But look looking out ahead, we can look at interest rate futures to get an idea of when the Fed might start to lower their interest rates. In July, for example, the market expects no changes, and the same thing in September. But by November, the stock market is pricing in a 70% chance that the Fed will finally decrease, and by December, the odds go up to a massive 90% chance. Now, this does not mean that this is exactly what will happen, because no one knows. That's what the stock market is pricing in today based on all the data that we have. But at the end of the day, no one knows if the Fed will pause and if this pause will be a temporary thing or if it's going to be a permanent thing. Either way, if the Federal Reserve increases rates this week, the stock market is not going to like that because that's not what it's predicting. But if the Fed does pause and it pauses at least for the next 12 months, then based on our past data, we should expect a reasonable chance to make some money in the stock market, at least on paper. Having said that, my personal investment journey is still gonna stay the same because I don't think I'm smart enough to outperform the market even though I have all this data. So the point is, I'm still buying exactly $100 a day of VTI, which is the broader market index fund. It works almost identical to VOO, but it's more diversified. And I'm buying $100 a day of SCHD, which is my dividend ETF for passive income. Hopefully this helped you prepare for what's about to happen this week. If it did, smash the like button. If it didn't, smash the like button anyway, because my career depends on it. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon, bye-bye.